Have you ever spent 3 months in the red? Not a bad day, not a bad week, 3 months. Where every weekly check of the account shows a number smaller than the last. If you have, you know that something changes inside you around month 2. You don't fight as hard. You don't get angry at losses anymore. You just absorb them quietly. And by month 3, the question changes from, how do I get back, to, is this still who I am? That moment, when the question changes, is the most important moment in trading psychology that nobody talks about. Today, we're going to talk about it. Welcome back. This is episode 12 of the Perp Trading Psychology series, Drawdown Survival. If episode 11 was about the short time frame of psychological pressure, tilt, which can happen in a single session, this one is about the long time frame, the slow grind, the weeks and months that test whether you actually have what it takes or whether you only had it during a bull market. Most traders never face a real drawdown. They quit before it can find them. The ones who survive long drawdowns become something different, something more durable. But the transformation is not gentle, and it's not glamorous. Quick explanation for anyone hearing this term applied to long-form psychology. A drawdown technically just means the gap between your peak account value and your current account value. A 30% drawdown means your account is 30% smaller than its highest point. But that's the math definition. The psychology definition is different. The psychology definition is the period when your nervous system is sustained in a state of loss anticipation, where every decision is weighted toward fear instead of opportunity. A 5% drawdown for one day is uncomfortable but manageable. A 30% drawdown over 6 months rewrites how you see yourself. The math is the same number on a different timeline. But the psychological impact is completely different. That's what we're talking about. Let's start with the neuroscience of sustained loss. When you take a single loss, your stress hormones spike and then dissipate. When you take losses for weeks on end, the spike doesn't dissipate. It baselines. Your nervous system normalizes the elevated cortisol. What used to feel like alarm now feels like background. You don't notice it because you're inside it. The same way you don't notice the temperature of a room you've been sitting in for 2 hours. But it's affecting everything. Your sleep quality drops. Your decision speed slows. Your willingness to take any kind of risk, even good risk, declines. Brain scans of people in sustained financial stress show measurable changes in the medial prefrontal cortex, the part of the brain that handles future planning. You literally become worse at planning forward when you've been losing for months. This is not weakness. This is biology responding rationally to sustained threat. But it's also exactly the wrong state for trading, because trading requires forward planning. And the more you need to think clearly, the less your brain is letting you. There's an identity shift that happens around the second month of a real drawdown that's worth understanding. In month 1, you tell yourself you're a profitable trader having a bad month. In month 2, the story starts to shift. I'm still a profitable trader. This is just the variance everyone talks about. By month 3, the story is changing again. I'm a trader who's been losing for a while. Maybe I lost the edge. Maybe I never had it. By month 4, if you make it to month 4, the story has fully shifted. Maybe I'm just not a trader. The shift from, I am a trader having a bad time, to, maybe I'm not a trader at all, happens gradually. So gradually most people don't notice it happening. But it's the most dangerous transition in long-term trading. Because once your identity decouples from your craft, your motivation to put in the work also decouples. You stop journaling. You stop reviewing setups. You start hate watching other traders on social media. You start doom scrolling instead of studying. The behavioral disengagement comes from the identity drift, not the other way around. There's a specific pattern that destroys most traders during drawdowns. The capital protection mode that becomes capital paralysis. Around month 2, most traders shift into what feels like prudent risk management. They size down. They take fewer trades. They wait for only the best setups. This sounds reasonable, and in moderation it is. But the sizing down often goes too far. The only the best setups criteria becomes so strict that nothing qualifies. You go from trading 3 setups a day at 1% risk to trading 1 setup a week at 0.3% risk. Now, even when you do take a trade and it works, the gains are too small to meaningfully recover the drawdown. You're stuck. The drawdown is no longer being repaired by good trading. It's just sitting there, slowly being chipped away by the rare small win. This is capital paralysis disguised as discipline. The discipline framing makes it feel virtuous. But the actual effect is that you've stopped trading meaningfully while still calling yourself a trader. Months pass. The account doesn't move. Your edge atrophies from lack of use. Eventually you either size back up, usually at the wrong time, when conditions don't match what your strategy was built for, or you quietly walk away. Either way, the paralysis killed the trader before the drawdown did. There's another pattern worth describing, the strategy switching trap. By month 3 of drawdown, many traders conclude, correctly or incorrectly, that their current strategy is the problem. So they start exploring. They read about other people's approaches. They paper trade new systems. They watch tutorials. This is sometimes the right move. Edges do degrade. Market regimes do change. But more often, the strategy switching is identity protection in disguise. If you switch strategies, the losses of the previous months become, those losses were from the old strategy, instead of, those losses were mine. The new strategy is psychologically clean. You haven't lost anything with it yet, so you commit. And the first losses on the new strategy hit even harder, because you had hoped this one would be different. A trader who switches strategies during drawdown without first proving the old strategy is broken usually just chains 2 losing periods together. The fix is, before you switch, run a real audit. Were your losing trades within strategy parameters? Or were they tilt-driven deviations? If the answer is tilt-driven deviations, the strategy isn't broken. Your nervous system is. And switching strategies doesn't fix nervous systems. There's a cultural amplifier in trader communities that makes drawdown survival harder. The performance posting culture. When you're in the red for 3 months, your social media feed is full of people posting green months. You know intellectually that most of those posts are cherry-picked. That for every trader posting wins, there are 10 who are quiet because they're losing. But knowing it doesn't insulate you from feeling it. Every time you check the feed during drawdown, you take another small hit to morale. The cumulative damage of social media exposure during drawdown is enormous. Far more than any single losing trade. The fix is, during drawdown, mute the feeds, not for the whole month, for the duration of the drawdown. This sounds extreme. It is. And it works. Pros who have survived multiple drawdowns will tell you the same thing. The first action they take when they enter a difficult period is digital isolation from other traders' wins. Not because they're jealous, because their nervous system already has enough to process. Adding the social comparison layer on top of the drawdown layer is what tips people from survivable into broken. There's a quieter pattern during drawdowns that most traders don't notice until it's done its damage. The bleed into non-trading life. A long drawdown doesn't stay in the trading account. It leaks out everywhere. You become less patient with your family, less present in conversations, less interested in the activities that used to recharge you. You eat slightly worse. You sleep slightly worse. You exercise slightly less. Each individual change is small. You barely notice it. But across 3 months of drawdown, the cumulative effect on your daily energy and your relationships is significant. The trader who emerges from a 6-month drawdown with their relationships and health intact is a rarer breed than people realize. Most emerge with the trading damage matched by collateral damage in other parts of life. This is one of the strongest arguments for active recovery rituals during drawdown. Not because they save the account, because they save the life around the account. The pro who survives multiple drawdowns over a decade-long career has usually learned to protect the non-trading parts of life with the same rigor they apply to risk management. The trader who only protects the account often emerges from drawdowns with the account intact, but the surrounding life hollowed out. The two failure modes are different, but the second one is more expensive over time. There's a leverage angle to drawdowns that matters. Drawdowns on perps are not just psychologically harder, they're structurally different. On spot, a 30% drawdown means your account is at 70% of its peak. You still have capital. You still have time. On perps, a 30% account drawdown could correspond to a 5% asset move at 6x leverage. That the real damage in market terms is smaller than the account number suggests. But the inverse is also true. If you size back up to recover the drawdown faster, you can be one bad trade away from liquidation, in a way spot traders never are. Drawdown psychology on perps is a tighter rope. The recovery moves available to you are smaller, and the failure modes are more severe. This means perp drawdowns require longer recovery time, more conservative sizing, and more patience than equivalent spot drawdowns. Pros who've traded both will tell you the recovery period on a perp drawdown is roughly double what it would be on spot for the same percentage damage. If you can't accept that math, you'll always blow the recovery by sizing up too fast. So how do you survive a real drawdown psychologically? I'll give you 3 practical rules. 1. Define your recovery rules in advance. Before the drawdown, decide what level of damage triggers what response. 5% drawdown, no change to behavior. 10% drawdown, reduce sizing by 25%. 15% drawdown, close out positions, take 3 days off, then return at half size. 20% drawdown, pause for a full week, audit every trade from the period, then return at quarter size. 25% or worse, extended pause, professional review if possible. The numbers don't have to match this exactly. The structure is what matters. Having predefined rules means you don't have to make decisions while emotionally compromised. The rules made by your morning self are stronger than the impulses of your tilt self. 2. Journal the drawdown story, not the trades. During drawdown, your usual trade journal becomes hard to keep up with. The trades all feel the same. Bad. Switch to journaling the story instead. How are you feeling? What's the narrative running in your head right now? Where are you noticing the identity drift? This kind of journaling is less popular, but more useful during long down periods. It catches the identity drift in writing before it captures you. 3. Maintain one non-trading activity at maximum intensity. This is counterintuitive, but critical. When you're in drawdown, the temptation is to retreat from everything, to shrink your life to just the chart. The opposite is what helps. Pick one non-trading activity: fitness, music, cooking, language learning, and increase your investment in it during drawdown. Not as escapism, as identity insurance. While the trading identity is under pressure, you need another identity holding ground. The trader with two identities survives the drawdown. The trader with only the trading identity loses the trader along with the drawdown. There's a flip side worth knowing. Professional traders treat drawdowns as the most important learning periods of their careers. This sounds insane to a trader currently in one. How is this period, when nothing works and everything hurts, possibly useful? But ask any pro who's survived multiple drawdowns. They'll tell you the same thing. Their best later years happened because of what they learned during the worst earlier periods. The drawdown forces a level of honest self-examination that profitable periods can't produce. When you're winning, you can't tell what's working because of skill versus what's working because of luck. When you're losing for sustained periods, you start to see clearly. The fake confidence dies. The real edge, if it exists, becomes legible. Most importantly, the drawdown forces you to develop the psychological infrastructure that will keep you in the game for the next drawdown. Because there will be a next drawdown. The trader who survived one survives the next more easily. The trader who never had one is fragile in a way they don't yet know. The drawdown is the trainer, the painful one, the one that doesn't go easy on you, but the one that produces a trader who lasts. So to summarize today's episode, a real drawdown is not a math problem. It's a psychological transformation. It's driven by sustained elevated cortisol that rewires your forward planning. It produces identity drift from trader to maybe not a trader. It traps you in capital paralysis disguised as discipline. It pushes you into strategy switching that compounds the damage. It's amplified culturally by social media performance posts that erode morale. And on perps, it requires roughly twice the recovery time of spot drawdowns. The 3 practical rules define recovery rules in advance. Journal the drawdown story rather than the trades, and maintain one non-trading identity at maximum intensity. Underneath all of it is the realization that drawdowns are the most important teachers a trader has. The pro doesn't avoid them. The pro respects them. And the pro emerges from them as a different, better, more durable trader. In the next episode, we're going to talk about the opposite problem. Profit taking discipline. What happens when you finally have a winning position and your nervous system is screaming at you to take the profit? Even though the chart says hold, why the math of trading is asymmetric in a way that punishes early exits more than late exits, and the practical framework pros use to hold winners without anxiety. If episode 5 was about cutting winners too early at the level of a single trade, episode 13 will be about the discipline that lets you stop cutting winners altogether. Appreciate you all for listening. If this episode found you in a drawdown, you're not alone and you're not finished. Keep going. Subscribe and share with someone deep in the red. And I'll see you guys in episode 13. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.